Sean Haney here with RealAgriculture.com and RealAg Radio, Rural Radio 147, Sirius XM. Let's talk some markets. We're joined right now by the founding partner of agmarket.net. It is Jim McCormick. Hey, Jim, welcome.
Hey, good morning, Sean. Thanks for having me on.
Yeah, lots happening in the market right now. As we look at the markets at the time that we're doing this recording, a bit of I guess a mixed trade, quite a bit of red on the screen, probably more so than green. What's happening here in this week of trade? Is this the market a little bit uncertain about what happens with this Black Sea grain deal going forward, or what's at work?
Right now, I think there's a couple things going on. The first thing I'd say is actually a little bit of concern about the cash market, Sean. Yesterday in mid-session, especially in the corn market, the CIF value, the value of grain down at the Gulf kind of collapsed across the board, and a lot of weakening of the basis. So I think there's a little bit of concern of demand, export demand specifically for U.S. products, as Brazil continues to sell our products a little bit cheaper. So they're worried a little bit about demand. That's why we're under pressure right now. But the big concern, and probably on the macro front, on the international front, is definitely this grain sea corridor. The shutdown, what is it, the 18th is when the deal technically expires. I'm in the camp personally that I think they will shut it down. I think Putin's going to, at least temporarily, Putin wants to wait and see how hard the G7 comes after him. If they come after him hard without any sanctions relief, I think he's going to try to squeeze the world a little bit. The other thing, I think, China was taking a lot of corn from the Ukrainians, but now the Chinese can take some of that corn from the Brazilians. They've got a big crop to export. Maybe that takes a little bit of pressure off Putin to keep the corridor open as well. So we'll keep an eye on that. If that does get shut down for a extended period of time, I think that would be a little bit friendly to all crops in the North American hemisphere, as it'll shift the demand around to, or supply around, of who can supply the world's food.
Yeah, wasn't the tell last week when Ukraine's ag minister said that it wouldn't be a catastrophic event if that deal wasn't renewed? That kind of, when Ukraine's saying that, you got to wonder where these talks are, because there's actually, I read in Reuters this morning, there's no talks planned to extend that agreement this week. So maybe this is already a little bit of a done deal.
I think it's baked in the cake right now. I think the fact is nothing can't happen over the weekend, and I think now it's just where it's at. And now we're going to see how long it actually, is it days, is it 2 days, is it a week, or is it a month? The longer it goes on, the more unnerving it will be probably for the world buyers.
On the demand front, as you're alluding to, a bit of a weakness out there. Is this based on the fact that, as you said, Brazil, there's some cheaper places to be buying some of these commodities, or is there something more at work on the macroeconomic level where there's some concern about the global economy here, as we've seen rates, I guess, go up at a pretty strong rate here the past 24 months?
Well, there's two things that are probably at the forefront on the macro front right this moment, Sean. The first one here, domestically, at least here in the States, it's the debt ceiling. We're racing toward that debacle really, really quick. No one believes they're going to go over the guardrail and we will actually default on the U.S. debt. But let's face it, a lot of weird things have happened the last few years where people said, oh, that'll never happen. And it's happened. So I think there's a little bit of uncertainty about if that would happen, what would that do economically? I think in general, the consensus is it would be very negative the U.S. economy, which would spill in the world. So I think that's partly what's dragging the market a little bit. The other thing is news coming out of China. Their economy did not have that COVID rebound like a lot of the economies of the world did when they come out of lockdown. The growth's not there. There were some reports now that unemployment for adults, young adults, roughly age to 25 is like 25%. There's more. You get the college grads that are just coming out of school here the next couple of weeks, and that just shows you the world's, the China, the kind of the big engine for the world's demand over the last decade is slowing down, and that's a little bit of a concern. And that's a concern here in the States for the bean exports specifically. We ship a lot of beans to China. If their economy is not growing, their bean export number might be overstated, and we might see more cuts in the exports to China.
Jim, how much weight do you put in the discussion about the concerns of certain countries, buying commodities in the Chinese yuan instead of the US dollar? Is that something that is taking up a lot of your headspace as you try to break down this everything that's happening geopolitically right now?
Well, I think it's a concern. I think it is a concern, but the reality is, that's the transition of history. If you look over the history, arcs of history, there have been other currencies that were the dominant currency. The United States, we are not, we may have one of the strongest economies, one of the strongest militaries, but when you get in this conflict that we've had with the Chinese the last couple of years, the Chinese are going to try to wean them away from it. I'm not quite fearful of it, though. I think it's something we need to be concerned about. But the reality is, if someone needs our product, we're going to take dollars to buy it. If you want our corn, you're going to take dollars. They'll convert it back into it. So the fact that they're, the Pakistanis are trading, buying Chinese good and Chinese currencies, it's something you don't like to see if a U.S. American. But the reality is that's probably the arc we're going to go on, and that's just as the world history goes around, that's usually what happens. The world moves from one currency to another. It just does.
Yeah. Okay. From a domestic planting standpoint, how do you break down those USDA planting progress reports?
We're running way ahead of schedule, plain and simple. I mean, if you look at it compared to last year, compared to the averages, this crop is getting into the field at a very, very rapid pace for the most part. The northern tier states closer to the Canadian borders are probably struggling the most, but as a whole, we're off to a relatively good start. There is some rain out there. I mean, you're not here. We've had some replants going on in parts of Illinois and Indiana where we've had too much rain over the last couple of weeks, but overall, this crop looks good. And if you look at that, unfortunately, in the pricing sector, I think that means we're probably going to get most of these acres anticipated planted. History is kind of bearish for us right just now. We are moving into El Nino, Sean, very, very fast by all accounts. One stat that I heard from one weather forecaster said out of the 17 years we've had El Nino during the growing seasons, 14 of them we ended up with trend yield or better in the United States. Now, trend yield is 181.5 as a mathematical trend yield. That is about 5 bushels better than we ever had. So the market's kind of taking that, well, are we really going to hit trend with kind of a grain of salt? But the history is on the bear side that you do hit that 181.5 potentially. You take that 181.5 with 90, 91, or 91, 92 million planted acres. 92 is the working number. Maybe shave it back even a million. You're still looking at a 2 billion, 2.1, 2.2 billion carryout potentially. That is essentially probably is going to push corn prices on the Board of Trade into the low fours by the fall, if that does come to fruition.
If you're banking on the weather market for some of these spring planted crops, it's not working out that way based on the planting progress and kind of what the weather patterns are at this point. It's a little bit of a concern.
I would agree. I would agree. If you were looking for the, hey, maybe we're not going to get it planted rally, that rally seems to have moved on at this point for the most part. Can we get a rally? Now, historically, if you look in years, 2013 is a year we kind of use as an analog year this year. In other years, you tend to get pushes back up roughly between now and the middle to the latter part of June. Let's just say, Independence Day, United States, July 4th weekend. You tend to get weather rallies, that'll happen in most years. Those are rallies that we're encouraging producers out there to really get aggressive about, because usually weather rallies do not last. And if you do get it, it's probably going to be short-lived just based on this El Nino study that we have. Yeah. But yeah, I mean, where could that rally come from? It could come from shutting down the grain corridor. That could be what kind of gets market excited. China coming in unexpectedly buying a lot of grain. South America, interesting, Sean, is they're a little bit dry in parts of the safrinha corn crop as they're running the latter part of that crop out. Does that get the market a little bit excited? And then the western part of the United States, the western corn belt, according to the drought monitor, is still quite dry, even though they've had rain recently. So those are the reasons that you might get the market get a little too wet, too dry, too cold type of bounce. But history says that bounce needs to be aggressively marketed.
And that, yeah, okay, that's the key point here. The tail of the bounce, or trying to put together a justification where we could see a little bit of maybe a couple upside days or maybe a week. Those are an opportunity, a selling opportunity, as opposed to transitioning back into what we had basically the past 2-3 years, which has been this buy and hold strategy where all of the strength is in the seller's hands. That has really, we've transitioned to a different kind of marketing market at this point.
You nailed it. The reality is the boat's turned. We are no longer in a bull market. In general, we believe we're more in a bear market. We are in a stocks building market. The market's going to pay you storage more than likely as we get into fall, store grain into the spring and summer. It's just the cycle of agriculture. When you think about what happens, we've had a very tight supply in the United States. We've had tight supply around the world, and that has driven the prices to astronomically, historically high levels. The war was probably the apex of it like a year ago. Now we're going to coming out of that. And what happens? The world responded to these to these rallies, supply driven rallies, by essentially increasing supply. We've got a big safrinha corn crop, potentially a big US corn crop. We'll see how Canada comes out. Canada's a little bit dry here and there, but in general, the world supply, if you look at what the government's suggesting, the world carryouts are starting to grow. So we're moving more into a long-term bear market. The energy market continues to struggle. Crude oil can't get much over $80. Every time it does, it gets smacked back down. The crude oil tends to be the canary in the coal mine for the overall commodities. If China's economy is going to start to roar into life, you'll see it in the energy markets first. And the energy markets tend to kind of pull all the markets up. The energy markets have been struggling right now. Nat gas is at dirt cheap prices. You're hearing we're taking nat gas rigs offline at some of the quickest pace we've ever seen right now, as the market's trying to essentially stem the flood of nat gas on the world market at the moment. So all those, unfortunately, are kind of negative indicators for the commodity markets. And like I said, I think that lends our group to believe that rallies really need to be meant to be sold for the American agriculture, even for anybody who's producing, because we could oversupply ourselves into 2023 and really set ourselves up into some frustrating times for 2024, because the prices, Sean, is probably going to go down, but the reality is the cost of labor is probably not going to go down. With inflation, it's still running around 5%. Even if they get it down to 3 or 4, the employees are still going to want their raises. Land rent probably isn't going to go down much. The cost of land isn't, we don't, as I say, they don't make more of it. Rent's not going to drop. So what's going to happen is the prices of your product is going to go down. If agricultural commodities are going to go down, but your cost of producing, it's not going to drop as much, and it's going to make 2024 that much harder to cash flow.
Well, I was just going to ask you about inflation. So there has to be some, I'm sure there's a lag here, but as we see weakness in the energy markets, and of course we're seeing the bearish tone to the ag commodity complex, that, those are the inputs for the engine of the economy. Does this mean 6 months out or 12 months out that we really start to see inflation here really tail off, and maybe we get a little bit closer to that 2 to 3% window that would be more of the target for the Fed or like the Bank of Canada?
I think that's what you're going to see. And remember, that's the goal of this. I mean, that's the reality is, the Fed has told us all along they're going to slow down the economy. That was the whole key, was raising interest rates, make it more expensive to do business. That slows down the economy. And as you slow down the economy, you are going to essentially get a little bit of deflation to get it down to close to that inflation number they want. Now, how long does it take? It may, in the ag sector, it takes a little bit longer for that cycle to happen. But we believe you're seeing that cycle. And the old line is, you don't fight the Fed, you don't fight the Bank of Canada. They usually get the way they want. Maybe not as fast, maybe not as quick as we like, but normally, they have the strings that to either increase, to stimulate this economy or slow it down. And right now, the inflation is still the key. Now, I think we're just kind of at the tipping point. We've got inflation right around 5%. The Fed rate's right around 5%. So we're probably where we're going to pause it, but that's still too high on the inflationary aspect. So I think they're just going to keep slowing this economy down until they get it close to that target rate, somewhere, the average rate, inflation rate, somewhere around 2%.
Yeah, and just because they pause now, we saw this with Australia last week or the week before, where they were paused, and then all of a sudden they're raising rates again based on the data that they're seeing. So this is definitely a fluid situation. Just because they pause now doesn't mean, hey, that's the strategy going forward, and hey, reduce rates are right in front of us. This is definitely a moving situation, something that, especially with all the money that is borrowed in agriculture, we're definitely paying attention to interest rates. There is no doubt about that. Jim, thanks so much for joining me. Really appreciate it. All the best to you and everybody at agmarket.net. How do people get a hold of you?
Best way to reach us is go to agmarket.net or go to 844-424-6758. But if they're interested in looking at our research, agmarket.net.